today we are talking about something much bigger than property. We are talking about a pressure point that can affect oil, trade, shipping, inflation, stocks, confidence, and yes, eventually real estate. The question is, Strait of Hormuz tension. What does it mean for Dubai real estate?
Iran has militarized a number of islands off its southern coast by building airstrips, missile tunnels, drone sites, and hiding spots for attack boats and mine-laying capabilities. Some of the islands sit in and around the strategic Strait of Hormuz.
What if the Strait of Hormuz doesn't reopen? Not for a few days, not for a few weeks, but for a prolonged period. What would that do to UAE? What would that do to the world? Would trade prices jump? Would inflation rise? Would stock markets fall? Would property in Dubai freeze, fall, or become even more important as a safe haven asset? By the end of this video, I want to give you a factual, realistic answer. Not panic, not politics, just clarity. Let's start with why Hormuz matters so much. Because this is not just a Gulf story, this is a global economic story. The US Energy Information Administration says oil flows through the Strait of Hormuz averaged about 20 million barrels per day in 2024, equal to around 20% of global petroleum liquids consumption. Its broader choke points data also says first half 2025 flows averaged 20.9 million barrels per day, again around 20% of the world petroleum liquids consumption. The IMF said this month that roughly 1/5 of the global oil supply and LNG trade normally passes through Hormuz. It added that this includes almost half of Asia's oil imports and about 1/4 of Asia's LNG imports. So when people talk about the Strait of Hormuz, they are not talking about a small regional waterway. They are talking about one of the most important energy arteries on Earth. That is why this matters to everybody. Not just Gulf governments, not just oil traders, not just shipping companies, everybody. Because if a choke point like this stays shut, the impact spreads outward very fast. Energy, freight, insurance, import costs, inflation, stock market volatility, and then after that, confidence in long-term investment decisions, including real estate. What is happening right now? Now let's bring this into the current situation. Reuters also reported that Gulf producers are trying to bypass Hormuz, with Saudi Arabia ramping up use of its east-west pipeline and the UAE increasing flows through the Habshan-Fujairah pipeline to move exports out through the Gulf of Oman instead. This is important because it shows two things. First, the pressure is real enough that countries are actively rerouting around it. Secondly, the UAE is not passive. It is adapting. It is using infrastructure. It is trying to maintain continuity. And that matters for confidence. Because investors do not just watch the problem, they also watch the response. And one thing the UAE has consistently shown is that when pressure rises, the system responds. That does not mean that there is no impact. There is an impact. But it means the country is trying to manage it actively, not simply absorb it. What if the Strait of Hormuz doesn't reopen? First, let's be realistic. A never reopen scenario is extreme. In the real world, countries would keep trying military, diplomatic, and logistical solutions to restore some kind of movement. So the more realistic version of this question is, what if Hormuz stays badly disrupted for a long time? If that happened, the first major effect would be on energy supply. The IMF said the closure has already cut off access to roughly 20% of the world's oil and seaborne LNG supplies. That would mean higher oil prices for longer. And we are already seeing how sensitive prices are. Reuters reported Brent crude rose above $100 a barrel after having surged as high as $119.50 earlier in March 2026. ADNOC CEO Sultan Al Jaber said rising oil prices were already showing global growth. So if Hormuz stayed shut or heavily impaired, the world would likely face higher oil prices, higher gas prices, higher transport costs, higher shipping insurance costs, and a stronger inflation wave. That is the first layer. The second layer is trade. Because once shipping gets disrupted, prices do not only rise because of oil, they rise because movement itself becomes more expensive and less predictable. Freight gets delayed, insurance premium rises, alternative routes cost more, some goods arrive later, some goods become more expensive, some trades flows are rerouted entirely, and all of that works its way into pricing. That means fuel gets more expensive, imported goods face pressure, industrial inputs become more costly, air freight and shipping costs rise, and consumer inflation can stay elevated longer. So, if someone asks, would a prolonged Hormuz closure affect pricing and inflation? The answer is yes, very likely. Not just in the UAE, globally. Because Hormuz is too central to oil and LNG flows of the world to avoid that shock entirely. Now, does that mean supermarket prices instantly explode tomorrow? No, that would be too simplistic. What it means is the pressure builds through the chain. Energy first, shipping second, business costs third, consumer prices after that. That is how these shocks usually transmit. Now let's talk about stocks and global markets. Because when energy routes break, stock markets usually react before property markets do. And we are already seeing that. Reuters reported that on March 23rd, Dubai's main stock index fell 3% and Abu Dhabi's fell 1.5%, with Emaar down 4.6% and Aldar down by 5%. The next day, Dubai's index rebounded 2.5% and Emaar rose 4.4% as sentiments improved. That tells you something important. Markets are pricing not just today's disruption, but the fear of what comes next. So if Hormuz stayed shut for a long time, global stocks would likely stay under pressure in sectors tied to airlines, shipping, trade, tourism, consumer demand, and risk-sensitive assets in general. Energy producers might benefit from higher prices in some cases, but broader equity markets would likely face serious volatility because a prolonged energy and trade shock is not good for global growth. The IMF explicitly said world oil prices are up nearly 50% since December, and that Asia and Europe are facing steep gas price increases. So if people mean Google stocks as in the wider stock market, then yes, a prolonged Hormuz shutdown would likely mean more volatility across global equities, not just Gulf markets, especially for businesses exposed to logistics, travel imports, consumer demand, and inflation-sensitive spending. Now let's zoom into the UAE. If Hormuz remained shut for a prolonged period, the UAE would face both pressure and resilience at the same time. The pressure side is obvious. Regional risk rises, airlines stay disrupted, shipping stays disrupted, trade becomes more expensive, investor sentiments become more cautious, and some business decisions get delayed. Reuters reported Gulf airlines remain below normal capacity, with Emirates around 75% of normal operations, Etihad and Air Arabia around 50%, and Fly Dubai around 33%. Since the conflict began, Emirates alone has cancelled more than 2,000 flights, while more than 30,000 flights have been disrupted across the region. That affects tourism, it affects business travel, it affects short-term rental confidence, it affects how quickly international investors can move. But the UAE also has resilience factors. Reuters reported that UAE Central Bank introduced a resilience package, and that UAE bank holds nearly $250 billion in liquidity and assets. That matters because strong liquidity, strong institutions, and alternative export infrastructure do not remove the shock, but they do improve the country's ability to manage it. So the UAE would not be untouched, but it would also not be defenseless. And that is a very important distinction. Now the key question. What happens to Dubai real estate if Hormuz stays closed for a long time? The first answer is transactions would likely slow before prices broadly fall. That is almost always how property behaves. Real estate is slower than stocks. It is slower than oil. It is slower than headlines. The first thing to move is confidence, then activity. Then only later pricing if the pressure lasts long enough. So what would likely happen first? Buyers do become more cautious, viewings slow down, offers become lower, negotiations get tougher, sellers wait and the deal volume softens. That is stage 1. And then if the disruption lasts, the weaker parts of the market feel it first, not the stronger assets, not the rarest assets, usually the more exposed stock, low ticket units, heavily competed segments, more replaceable inventory, and sellers who need liquidity fast. That is where price pressure begins. Because if somebody owns a very ordinary asset and needs to sell into a nervous market, buyers can push harder. But strong, scarce, well-located property behaves completely different. Why? Because stronger assets usually have stronger sellers behind them. The strong sellers are more comfortable waiting. That is why Hormuz tension would not hit all of Dubai equally. It would hit the market in layers. Confidence first, volume second, weak stock third, prime stock last, if at all. Now here is the twist that makes this story more interesting. A prolonged Hormuz crisis could hurt confidence, yes, but it could also redirect capital. Because when the region becomes unstable, money does not always disappear. Often it moves towards the safest available platform. And Dubai remains one of the region's strongest safe haven cities for capital, business setup, and internationally recognized property ownership. That does not mean the crisis is good for Dubai. That would be the wrong message. But it does mean Dubai can benefit from relative positioning. If investors ask, where can I preserve value? Where can I move money more efficiently? Where can I still own globally understood real estate in the region? Dubai remains one of the first answers. And that is why the outcome is not a simple collapse story. A prolonged Hormuz problem would create real economic stress. But it could also strengthen Dubai's role as a safe haven destination inside that stress. And that is why real estate here may slow without necessarily breaking the way people expect it. So let's answer the biggest question honestly. What if the Strait of Hormuz doesn't reopen? Realistically, the world would keep trying to reopen it, bypass it, secure it, or partially restore movement. A permanent full closure is an extreme scenario. But if the disruption lasted a long time, the effects would be major and very real for the world. Higher oil and gas prices, higher shipping cost, higher inflation pressure, more stock market volatility, a slower global growth for the UAE, more caution in aviation, tourism, and trade, pressure on sentiment, but also support from infrastructure, banking, liquidity, policy response, and bypass routes like Fujairah. For Dubai real estate, first a confidence slowdown, then a transaction slowdown, then selective pressure on weaker segments, while stronger assets may hold better and Dubai may still attract safe haven capital. That is the realistic answer. Not nothing happens and not everything collapses. The truth is more intelligent than both extremes. If this helped you understand the bigger picture, make sure you like, share, and subscribe. And follow for more insights where we connect Dubai real estate to what is happening in the real world. Oil, trade, flights, markets, confidence, and capital flows. Because in times like this, the smartest investors are not just watching property, they are watching everything around. If you want real estate insights that go deeper than just launches, payment plans, and headlines, make sure you share this video, subscribe, and follow for more real estate market insights on Dubai and the UAE.